Welcome, everyone, to our monthly market update. This is ClearVista Financial Perspectives. I am Mark Trice, financial advisor and lead advisor here at ClearVista Financial. And I'm joined, as always, by Jesse Hamilton.
Hey, everybody, welcome.
So this has been an interesting month. Typically, February tends to be somewhat of a weaker month throughout the year, but it actually ended up quite productive. And we see a
Right.
lot of changes going on, still a lot of weaknesses, but we'll cover all those things in today's program.
Maybe it was the extra day, maybe it wasn't.
It was a leap year day. That's what it was. So we'll jump right in. Thanks for joining us, Jesse. I know you've got going to go over our agenda and announce a few things.
Sure. So we'll do our normal February 2024 performance. We'll make some comments on the markets and discuss the state of the economy. And we'll talk about the Fed, even though they didn't meet in February. We'll discuss our outlook on 2024. We'll talk about how this might impact you. And just as a reminder, we have a new way of communicating with you live and after if you're watching a recording. We can text at 254-282-0495. That's a great way to get a hold of us, or send us an email, info@clearvistafinancial.com. If you have a question live, that'd be awesome. We can answer it for you. And if you want to wait till later, that's fine too.
All right. Well, I've got my email up and my text up, so we're waiting on your questions if you want to send those in.
Perfect.
Jesse, I'm going to turn the camera off so folks can see all of the screen.
Perfect.
And let's go on and jump ahead.
So our first index is, of course, the S&P 500. Just as a reminder for anyone who's new here, this is called a candle chart, and each candle is a trading day. Red candles are down days, and green candles are up days where the price closed higher than it opened. The S&P 500 was positive 5.17% in February. Overall, generally a positive trend with a few gaps in the middle of the month. You can kind of see right in the middle of the month, there was a big gap down, and then a few days later, a big gap up. So definitely some volatility. That was on the 13th and the 22nd, where we had those big gaps. Overall, a strong performance for the index, but we'll talk in a moment about what the underlying holdings tell us. And here's a hint, it's similar to the story we've been telling over the past many months. These numbers look very strong, but we wanted to note that January 31st was a significantly down day. That first candle in the chart is a big red candle. So the numbers will get a little bit of a boost and be influenced by that, just when it comes to month-over-month performance.
Yeah. And we did get a couple of new highs. The S&P and the NASDAQ regained their highs. Jesse's going to cover those in just a moment.
Yep.
With that, but let me go on and advance to the next slide here.
So our next is the NASDAQ 100, tech-heavy index, cap-weighted, and of course heavily influenced by these large companies. And it tends to be a little bit more volatile than the S&P, and we did see that in February. For the month, it rose 6.12, but it had as much as a 4% swing in 7 trading days. You can see in the middle of the month there, it swung quite a bit. The same symptoms of the S&P are going to be present here. And on March 1st, as Mark mentioned, we did cross into a new all-time high, but it fell below it this week, actually. So we're not back up there again.
We'll see that continue to happen as the market recovers throughout the year, hopefully.
Here's the Russell 2000, which is the small cap index in the US. This rose 5.6% in the month of February. It had an initial decline for a few days, and then it had a series of runs where it had some really strong days in a row. This does seem like a strong performance for the month of February, but it's not as strong as we're hoping for compared to the other indexes. We really need to see this index outperform the other two we just talked about. And of course, lastly, we'll look at the long-term Treasury index in February. You don't have to be a rocket scientist to see what happened here, but it was down 2.57%, starting with that steep sell-off that it did not recover from for the entire month. And it fell below the 200-day moving average on the first or the second day of the month, which is a long-term sign of weakness. It's slightly recovered since then, but not looking strong for long-term bonds.
Yeah, and I think a lot of it, and as I'll go to our disclosures here, a lot of it had to do with the hope that the Federal Reserve was going to cut interest rates any day now. And that's beginning to back off a little bit. We're seeing speeches from Federal Reserve presidents that are saying just not yet, but maybe later this year. And so that's why the bond indexes have been pulling back a little bit. So we have our typical usual disclosure. We have to tell you about the indexes. They're indexes. They're not things that you can actually invest in. And let's move on, Jesse.
Here's a 2.5 year look back. The S&P 500 is in green and red, and the Russell 2000 is in blue. So I've updated it to show February of this year. But we've explained in the past about how 2021 saw the blue line outperforming the red and green line. These indexes then tracked together through 22, but then started to diverge in March of last year. So about a year ago, we saw them start to behave differently.
And that divergence is real important because, as we've said before, at every bear market in the history within the last 120 years has been led out. The way out has been led by small cap companies like the Russell, the companies that are on the Russell 2000 index.
Right.
And we're not seeing that. And Jesse said we saw this big divergence in March of last year, and we have continued to remain a little bit unhealthy there to this point.
Notice how this year, January and February, the red and green continues to go up and up.
Yeah.
And the blue line is going sideways.
Yep. And that's something that's a concern there, because if the large caps are going up, small caps, if it was a healthy market, should be as well. We're going to talk about a little bit more about this in just a moment.
So here's another way to look at it. And it's a little bit more complicated, but tells us some great information. This is a comparison chart between large caps and small caps. So we're going to look at the black line here. When this black line trends down, large caps are outperforming. So we can see that all of last year trending down, large caps are doing better. For a brief spell in the 1st of November, this trend shifted, but then it reversed again. So we had a brief glimmer of hope, and then it changed again on us.
And those of you that are clients, you've met with us, we know we talk about this all the time. And what we've seen has been in this last first part of the year, in January and February, we've seen that index, and they kind of held their own, but the small cap index has not really advanced at all compared to the large cap companies. Something we just have to keep an eye on.
Here's a chart that shows the percentage of stocks that are above their 200-day moving average. Generally, this 200-day moving average is seen as a sign of strength and bullishness. I want to point out how quickly we moved last year from 24% up to 65% in an extremely dramatic fashion.
That was really from the end of October through the end of the year.
That's right. So this is a dramatic shift, and it's really moved sideways since the beginning of the year. In January and February, it's been doing the same thing. We'd love to see this stay above 60, but it hasn't gotten there since January.
And why is that? Because the universe of stocks haven't been growing like the large caps. But let's talk just a moment, Jesse, about those large caps and what's really happening compared to small companies and even international stuff.
So here's an eye-opening chart, and I think fundamentally broken is a dramatic term here, but this shows the actual market value in trillions of dollars of the 7 largest stocks in the US compared to entire other countries' exchanges and the energy sector in the US. So Japan, China, Germany, they're a fraction of the size of these 7 companies.
The market capitalization of these 7 companies.
That's
now,
right.
We can't tell you those 7 companies because our compliance department doesn't like us to talk about individual stocks or anything like that.
But you know what they are.
You've heard about them in the news, and we've talked about the Magnificent Seven in the past, especially in 2023. That's changing now. It's really been the top 2 largest capitalized companies in the U.S. are leading the large cap indexes up. So that has even narrowed further. So
Sure.
Jesse, go ahead
Well, there has been one loser that kind of dropped out, and we won't tell you which one, but it's kind of the Magnificent Six now.
Yeah. Okay. So this is a continuation of that theme. This is from the same Wall Street Journal article we were talking about.
The far left bar is the six of the largest seven companies, specifically their fourth quarter earnings. And the middle bar is the 494 other large cap companies in the S&P 500. And then the far right bar is the overall index.
So these seven companies, their earnings changed year over year, fourth quarter to fourth quarter, 22 to 23, over 60%, while the rest of the S&P 500
Right.
declined.
That's right. So explained another way, this shows that six companies are making huge amounts of money and 494 are not, compared to a year ago.
Actually losing money. So that's really telling as far as the condition and the health of the market.
Right. Here's a few more index tracking that we follow. Before we shift into kind of our macroeconomic sector or part of the program, I thought this would be interesting to look at. The NASDAQ, of course, we mentioned has recovered since 2021. It's positive 7.2, the S&P 6.84. The long-term treasury, which is our fourth index that we covered earlier, is down about 5% this year. But the amazing part is, Mark, it's still down 39.2% from its previous high.
Right. And this is concerning because so many investors, especially folks that are in retirement accounts, retirement plans through your workplace, are holding a very high percentage of bonds because they're getting close to retirement.
Right.
And you generally have not seen your portfolios recover from the 2022 decline in the markets, where at one point long-term treasuries were down 40+%
Right.
during that time. I think it's interesting here because both the NASDAQ composite and the S&P 500 both have recovered in this last month in February. They've pulled back a little bit since then, so they're not pushing to new highs just yet. But for the NASDAQ, that last peak was in November of 2021, and for the S&P, it was January of, I should say, 2022 on there. But it's been a couple of years. It took full 2 years, and that's actually very fast.
It's a very quick recovery.
That's a very quick recovery. So it's important to note that. What about the moderate portfolio index?
Yeah, so we use a moderate benchmark for a lot of our clients, depending on your specific risk tolerance. But let's just say you're holding what we might call a balanced portfolio or something along those lines. You're up about 1% this year. And the frustrating part is you're still down 8.74% since the previous high. People don't understand that even if the S&P is recovered, your portfolio might not be. It's probably not.
Yeah, a lot of people think just because the indexes have recovered and hit the new highs that they are too.
Right.
And they're not really realizing what's going on in their individual portfolio.
If you put your entire portfolio in the S&P, that's extremely high risk. But yeah, you'd be recovered.
So the S&P 500 equal weight, I know that's one that kind of encapsulates, excuse me, includes, let me pick a new word. I'm having trouble with that word today. It includes an equal weighting, so it puts more weight towards the smaller cap companies. The big mega caps don't get as much of a vote here.
In my opinion, this is one of the most positive figures on this entire page.
Yes,
because it's up 3% and it's almost reached its previous peak, which is really encouraging.
Yeah, and we haven't seen a close above that yet, but we're very close to that. And that's another thing that's positive about how the market is shifting.
Yep.
All right, so let's get into the macroeconomic outlook.
Just a reminder, we'd love to get a text from you at 254-282-0495. Any question that you have about what we talked about, or maybe your portfolio, whatever you want, we'd love to hear from you.
Great, and we are checking that as we go throughout the program today to see if anyone has that. But those emails and that text can work anytime. So if you're listening to the recording in a few weeks, once we get it out there, you can, in fact, send us a text or an email, and we'll get back to you hopefully within 24 hours.
So we got CPI data. Let's talk about that first.
Yeah, let's jump into that. Consumer Price Index. And this is the measure of inflation.
Yeah, it rose to 0.3% in January. That actually was higher than the consensus. It's up 3.1% from a year ago. If you want to read your own version of the release, you can go to the BLS.gov. It's if you're nerding out about that. So
Yeah, and they adjusted the December numbers as well higher.
right.
So inflation really is not cooling down that fast. We got a couple of things that are going on here. Yeah, we know the measure of money in the economy is down the past year, and that's a concern. But that's usually seen in a lag. You know, you're not going to see the effects of that till later on. And so with those consumer prices rising 0.3%, you know, the press may say, oh, we're getting better and things. But one thing that we noted here was that the reason that we think that headline inflation was held down in January was by the volatile energy sector, where there was probably about a 3.3% drop in gasoline prices. But when you strip out this category along with the food, that shows the core inflation, which is what the Fed likes to look at, the 12-month average remained stubbornly at almost 4%, 3.9%. It increased 0.4% in the month of February.
Although we do need gas and food, that's really what we're feeling is that higher
That's
number.
right. And so we're still having prices go up. And rents were up. What the Fed really looks like, the Federal Reserve looks like, and what they're watching very closely is that super core. You know, it excludes food, energy, other goods, and housing rents, okay? But it's a useful gauge of inflation in the service sector. That measure was up 0.8% in January. And that's the biggest increase we've seen in the services sector since April of 2022, when everybody was beginning to feel the pressure of high inflation across the board.
So that's like eating out and things like that.
Well, this is anything to do with the service sector. So this is, you know, things like that. But there's also when you talk about businesses that are service oriented and things like that, those prices are measuring. And it's been up over the last 12 months about 4.4%. And it's been accelerating in the last 3 to 6 months. Now that is causing some concern amongst the Federal Reserve that inflation has not cooled down yet. And that's what they're watching for. That's why they didn't cut rates in January. They're probably not going to cut rates in March, but that still remains to be seen. But there's really not, because of this super core inflation increase, things like medical services, hotels and motels, that means that they're really no hurry to cut rates because they don't want a repeat of the 1970s.
Right. This chart shows the CPI in a graph bar chart over the past 14 months. We can see how it remains high, and Americans are really feeling this. And I'll talk in a second, but have Americans accepted that this will just continue to happen?
I think a lot of people maybe have.
Inflation never decreases, rarely, sometimes.
Sometimes we do have deflation, but inflation is always going on. So whether it's below or at the target of the 2% is what the Fed tries to keep it at, or if it's up like it was last year in the 6s and higher,
right?
Folks are still feeling the effects. When it's below 4, but it's well above the 2% that the Fed is looking for.
And just because this graph looks flat over the fourth quarter, that means it's still accelerating at that pace.
Yes.
That does not mean it's unchanged.
Right. Prices are still going up. Very rarely do we see in our economy where prices actually go down. There are reasons that prices may go down over time, but it has to do with productivity and technology efficiencies and things like that, not the cost of basic goods and services.
I thought this map was interesting. Different people are experiencing different levels of inflation.
Yeah, I mean, the lowest rates of inflation are you're going to see up in the Northeast and Maine. Maybe it's just because it's so cold in the wintertime, people just don't spend money. I don't know. But here in Texas, we're kind of in the middle in that 3 to 3.2 range. But you see higher rates of inflation along the eastern seaboard and, of course, the West Coast. But kind of interesting to see that, you know, it's just not the inflation is not increasing at the same rate everywhere around the country. A lot of factors there that go into that.
Well, I've got friends and family in California and Tennessee, so they're feeling it.
Yeah, exactly. So, you know, apparently we got a good economy. The employment's not slowing down very much, but apparently no one told the U.S. manufacturing sector that the economy is doing great.
Right. The manufacturing index declined in February. It lagged the consensus and fell below that level of 50, which is what we consider expansion.
Yeah, so a level of 50 and above is expansion, meaning manufacturing companies are having more output. Below that means that their orders are slowing down and they're not putting out as much of goods.
Yep,
So
it was 52.5 in January, so big
yeah,
difference.
and that fell from the previous month. We had a period of time there that it was a little higher and we were above 50, but we fell back below 50 during this time. And we've seen that construction spending declined in January as well. This was really important to note here. And so we'll keep watching these things as we go along.
So here's the non-manufacturing index. You alluded to this earlier,
Yeah,
Mark, but
the
this is
services
the service
sector,
sector.
right.
Yeah. It's different. It's a different number. It declined slightly, but it's still in the expansion category.
Right. And everyone thought it would be above, well above 53, but it was actually 52.6, just a slightly below. But that fell from 64 back in January. So maybe the services sector is starting to cool off a little bit, but we'll have to wait until next month to see how the February data looks like. But it's well below that back-breaking pace from 21, 22 at post-COVID. But 13 industries report paying higher prices during the month of February.
Yeah, our economists that we follow at First Trust, they call it the economic morphine that's wearing off from COVID. Thought that was a great image.
Yeah, I mean, the service sector was a lifeline for the U.S. economy in 2023.
Yeah.
And so, what's going to happen in 2024, don't know. But, if the economy is coming off that services morphine because of scaling back up from COVID, and they got reductions in the money supply,
People are spending money.
Yes, people are spending money like they don't have it. And so that's important to look. Americans bought cars in January at a 15.8 million rate in February. That's up 6% from January and 6.3% higher from a year ago. So lots of positive signs there in the services sector, but maybe it's beginning to cool down.
So what about interest rates? High interest rates are still facing Americans who plan on using mortgages and car loans and other debt forms. Yesterday, Mark, I was in the office with one of our partner credit unions.
Yeah.
And I overheard one of the loan officers saying how February was kind of slow. And then in March, they've already seen more applications than they have in all of February.
Yeah, so maybe there's some pent-up demand there. People were thinking, well, rates are going to go down. They did go down slightly in January at the first part of February, but they are ticking back up.
Does this mean that borrowers are more willing to accept higher rates?
I think, once again, that maybe it is. And for a lot of younger folks, having a mortgage rate at 7% seems outrageous to them, right?
Yeah.
And many of our listeners here maybe had a mortgage in the early 1980s that was 15 or 16%. I know when I bought my first home, it was around 9. And so historically speaking, their rates are still moderately at a moderate level, but a lot of younger buyers and borrowers are thinking that's outrageous. So it's all about perspective. And it just could mean that more and more consumers are willing to go ahead and accept a higher rate to get new vehicles and homes and things of that nature. Okay.
So here's the Treasury yield curve, which we always look at on this program. As of the end of February, relatively unchanged since our last market update. But as a reminder, it's still inverted. And that started in March of 2022. So congratulations, the yield curve turns 2 years.
Yeah, and that's a long time to have a inverted yield curve.
Yes, it is.
And the reason for that is that typically when the yield curve inverts like this, because we normally like to see something like this, where the shorter term rates are much lower than the longer term rates, and we don't see that. That typically has been a precursor to a recession. Now, I know we've been talking about this for a while.
Every single time.
Yeah. Every single time that has been a precursor. But, we've been watching this for now 2 years.
Yep.
And we still haven't gone into a recession yet. Will we? I don't know. I don't have a crystal ball. But this is something that, you'll see over here that the 1 month yield over here is in the 5.5% range, and 30-year yield is over here in the 4.4%. So the 10-year, which is one that we watch for, borrowing costs and things of that nature, it's around 4.25. So, this is the reason that we think the market has been going up in the last 4 months has been because of that hope that interest rates are going to get cut, and we'll see this yield curve go back and be normal again. But this is just something that we're having to watch. Is not typical that we have seen an inverted yield curve for so long.
So the Fed does meet in March. We have
Yes.
brisk inflation. We have hiring data in January. It really hasn't altered the Fed's expectation that it will be appropriate to cut this year. But Jay Powell did say that he wants more evidence that inflation is slowing.
Yeah, so for him, that's been a weakening job market,
Yeah.
which we haven't seen, and inflation continuing to go down, which we haven't seen, especially in the services sector. They're very nervous about cutting rates too soon. I know today the European banks,
The ECB.
ECB did not cut rates. That doesn't mean that the Fed will respond to that. It just means that other countries and other European Union around the world are not cutting rates either. And so, in fact, we think Japan will actually raise rates when their meeting comes around here real soon. So just remember, they're trying to balance two risks. One is if they move too slowly to ease, monetary policy, and the economy crumples under the weight of higher interest rates, that's one possibility. The other is they ease too early, allowing inflation to become entrenched at a level well above that 2% rate that is their goal.
They kind of lose their power if that happens. They lose their tool.
Right. And so they're trying to be extra cautious and making sure we see that. I would not want to be in their position because it affects the lives of so many. But they're going to meet, I think the week of somewhere in the 19th to 20th of March. We should have consumer price index for February by then. That'll be a key data point. And tomorrow we should see the labor report for the month of February as well. So lots of things out there that you have to consider.
So I put the sports team on here because we want to talk about how this impacts you. You're probably getting engaged in your springtime activities. We're getting conflicting data, a market that has indexes at all-time highs, but maybe your portfolio's not. What does this all mean for you? We really don't have a crystal ball. We don't know what's going to happen, but let's talk about our strategy.
Okay. So, these bullet points that are on the screen are all things you're probably feeling as we enter the third month of 2024.
Yep.
Inflation is growing at a slower pace than the last 18 months, but we can't forget inflation's still going up. Prices are still going up.
Yeah.
Everyday items are expensive compared to where they were 2 years ago. We've already shown you how market signals are mixed, and we'll continue to watch those very closely.
Yep.
Interest rates still are high compared to what it was just a few years ago. And those are impacting our decisions to buy and finance a car, a home, or another large purchase. But it also means, Jesse, that banks and credit unions are paying higher deposit rates.
Yeah, make sure you take advantage of that. If your savings account's earning point nothing, you can do better right now.
Yeah, and we've seen that a lot of people are not searching for that yield. If you're determined to hang on to a lot of cash because you don't want to invest, or maybe cash is your safety net, make sure you're looking for a higher yield.
We're talking like north of 4%.
Yeah, north of 4% for short-term type money.
Yeah.
But we've also seen, Jesse, that credit card debt's higher. It's been in several years. I mean, Americans own several $1 trillion of credit card debt.
That's right. You said we're spending money we don't have.
And we've already mentioned that the money supply is low, and that's less money flowing around the economy.
Yep. And we're not going to get into politics here, but of course, everyone's thinking about the rerun, Trump versus Biden, that we're dealing with.
Yeah, it looks like it's going to happen. And I know could be not more excited than anybody. But the thing that we have to remind people is a lot of people use an election time to justify why you should just ignore everything and hide under a rock.
It's probably the number one question we get in client meetings is, well, if so-and-so gets elected, should we put all our money in the large caps? It's like, well, no.
The reality is, and we've done research on this over the years, and presidential elections typically don't move the markets for either party.
Right.
We should do that next time. So I think I promised that last time, and I forgot. But we should do that and show performance of the S&P over periods of time in the year of a presidential election and the year after a presidential election. And
there's some pretty robust research on that we found.
Yes, absolutely. And we don't want we're watching the data. That's all we care about, is what determines price is supply and demand. And it has really nothing to do with who's in the White House or not in the White House. Yes, there are consequences of who we elect to put in Washington, but markets adapt and they evolve and move.
Yep.
And so we're just trying to encourage our listeners to avoid panic or make those decisions based on headlines. First of all, headline writers are horrible. They don't, I mean, we can read a one that says that the world is coming to an end and find out that, the price of chewing gum went up 10 cents. So
our two primary resources that we use for live information sometimes have complete opposite headlines.
Oh, yes. We have different news sources that we monitor throughout the week, and we can look at two different headlines and they say two different things. And it's amazing. So we just say, hey, don't make any decisions based on the headlines. Call us. We'll be happy to talk to you.
Yep.
Remember that 254-282-0495 is one of our numbers where you can text. You can also send us an email at info@ClearVistaFinancial.
And believe it or not, no matter what happens politically, our strategy does not change. We don't see those things as related at all.
Yeah, and we still believe in the U.S. future is relatively bright.
Yeah, there are great things happening, despite we might sound negative in these reviews. We don't mean to be negative. There's lots of good things happening.
I mean, artificial intelligence has the potential to make our lives easier.
Mm-hmm.
I'm not too worried about robots taking my medicine or anything like that. But
don't want to rewatch The Matrix.
Yeah, and so it's going to help business run more efficiently, but they will never replace the need for human beings.
Right.
We believe we were created for more, and that's our view on the world.
I put this in the presentation last week. If you're asking, what about my 401k? A lot of you have a majority of your retirement savings in a plan like this. Maybe you're using a target date fund, or maybe you have no idea what's going on. If you would like guidance on this, please give us a call. There's probably a better option.
Yeah, and while we can't take control of everyone 401k to help you manage that directly, there are lots of options. So we have a service that you can at least get some advice when the market changes. We also have, and you make your own decisions.
Mm-hmm.
We also have tools, depending on your age, you could maybe get that money out of your 401k and control it in your own individual IRA.
Right.
But give us a call to talk about these things, because a lot of people don't realize that we have some very unique tools that will help you as a unique investor and make some sense of the market.
Right. If you work for a large company, we probably have all the options already from that company. If you work for a tiny company, great, send it to us and we'll add it.
Yeah, and we'll be happy to help you with that. So as we dive into 2024, we're here and now in the third month, wrapping up the first quarter of the year. We just want to encourage you to take action.
Mm-hmm.
All right. Your financial journey is important to us, and we're always here to help navigate that world of financial planning and risk. And whether it's a recession, a bull, or a bear market, or anything in between, please let us know if we can help. If you have just a few questions or any questions about your portfolio, your financial plan, give us a call. The most important thing you can do is take action.
Right. So we always encourage you to do these three things: check your statements, talk to a professional, and educate yourself so you really understand what's going on.
And if you don't have a trusted financial professional, feel free to give us a call. We'd be glad to help you. Jesse, I'm going to turn the video on. I'll look and see if we've got any questions.
Okay. You want to put our contact information?
Yeah, I'll put that up here in just a moment.
Once again, that text line, which is most people prefer, is 254-282-0495.
And so folks are being a little shy today. They're not sending us any questions in right now, but know that if you have one that comes up after our webinar or after you've listened to this webinar, you can send us an email at info@clearvistafinancial.com or text us at that number's not up there, but it's 254-282-0495. And you can actually schedule an appointment with me at any time by clicking on the Calendly link or going to the Calendly link there as well. So everyone that's listening to this webinar, no matter when it is, you've got an offer for a complimentary consultation. We'll be glad to help you look at your portfolio, look at your financial plan, answer some of your most basic questions so that you can feel confident that you're on the right track. And we'd be happy to help visit with you. So Jesse, from all of us from ClearVista Financial, we want to thank you for joining us today. There'll be a brief survey after the recording today. Please take a moment to fill that out. But thanks for joining us. Have a great week.
Thanks.